So first question, what investment structure should you be investing through? So if you look at the broad investment structures, you can invest in your own names or in joint names in a trust, a company, and superannuation. And superannuation is divided into two phases, the accumulation phase and the pension phase. And if we just look at tax rates, there are other reasons why you might choose different structures, but if we just look at tax rates, then somebody on earning an income or the average income, investing in their own names and the investments positively geared. So say for example it's a term deposit, you're on $60,000, your tax rate's 32.5, or if you add the Medicare levy it's 34% this financial year. So if that term deposit earns interest, then you're going to lose over a third of that interest in tax. And so from a tax perspective, that's not always the best thing to do. If you're earning less than $6,000, or actually the tax-free threshold this year is just over $20,000. So if you're earning less than $20,000, then you're potentially paying no tax, and investing in your own name is not a bad option. You can invest in joint names, but the same thing applies in terms of you'll pay your marginal tax rates. You can invest in a trust, and sometimes that's beneficial for people who have got a large sum of money, and particularly if they want to distribute income to other beneficiaries like their local church, because they can do that prior to paying any tax. If you don't distribute funds within a trust, you can pay 45% tax. We generally never never recommend investing through a company because it's a flat 30% tax rate, and also you don't get a discounting. So we're talking about two different things here. If you earn income, so if you owned an investment property, the rent that you charged would be the income, and capital gain would be if you sold it for more than you bought it for. If you did that and you triggered a gain and you held the asset for longer than 12 months, then when you own it in your own names, the gain is discounted by 50%. When you own it in your superannuation fund, it's discounted as well, but if you own it in a company, it's not discounted. So it's not the best structure. A company is not the best structure to hold your growth assets in. In superannuation, you're in accumulation phase where you're putting money into your super fund. Then you pay 15% tax on earnings, 10% on capital gains that are held longer than 12 months. And in pension phase, that's a phase that you can start to utilise when you reach your preservation age, which is currently 55 years of age. Then there's no tax. And so that's why often people are encouraged to invest retirement assets in the pension phase of superannuation because of this 0% tax rate. So first you need to decide your structure. Which one's right for you? Individual names, joint names, trust, company, superannuation. There are a few others out there like investment bonds. They were previously called insurance bonds. There are things like the First Home Savers account. There are a couple of other options, but these are the broad ones when you've got a chunk of money to invest. So first decide your investment structure, then secondly decide your investment option, the one that's right for you.